2026, you're looking at 150 basis points. That'll take us to a Fed funds rate of 4%. Okay, which is wild. Okay,
but, incredible.
Okay, but here, this is the crazy part that no one's actually factoring in. If that's what the Fed does, that means something either has broken, and they need to provide a little bit more relief than they wanted to, or something is on the verge of collapsing and breaking.
So this from Yahoo Finance earlier today, article titled, Regional Bank Indices Just Erased All Losses Since the Fall of Silicon Valley Bank. So I want to put that in perspective. I want to frame this.
Yeah, that's good. That's good, yeah.
I want to give everybody a little bit of thought, okay? During the contagion period that's what we call March of 2023.
Which was what? What was that contagion period?
There was a run on banks which led to the ultimate failure of three banks: Signature Bank, Silicon Valley Bank, and First Republic Bank. And this is because there was unrealized losses in their treasuries securities portfolios.
Right.
But the reality was that all banks had assets that were now worth less than they were before because the interest rate increases meant that the assets they had on their books were paying less than current market rates.
Right. Imagine you bought a house that was underwater, and if someone was asking you, I need to get money from you, and you're like, well, I can still afford my house. I still have my job. Everything is fine.
Yeah.
What are you doing? And you're like, no, I need all my money from you. And you're like, okay, now I'm going to have to lose my house.
So it was a problem, and it dragged some of these bank stocks down big time. If you're in the business like me, you look at them about how they're trading to tangible book value, right? If you're trading at or below tangible book value, it's very different than you're trading well above it. You're trading above tangible book value, people see you as a future value to them. They know that your price is going to rise. You're trading below it, they think your price is going to go down. It's very simple. It sounds all complicated and financy and shit, but that's all it is.
Yeah.
Right? So just food for thought. Let's quote the article from Yahoo Finance. Regional bank indices are now back to where they were when a March crisis began. A significant moment from an industry recovering from one of its most challenging years since the 2008 financial crisis. The two major indices that track mid-sized lenders are currently trading above levels last seen in the moments before March 10th fall of Silicon Valley Bank, an event that triggered widespread panic in the banking system. Now, okay, just fun little food for thought.
Yeah.
This is not because we cut rates.
Yes, exactly.
This is only because the Fed said, we might cut rates.
So correct me if I'm wrong. A lot of the banks out there that were suffering from the same unrealized losses that those three banks went under for, right? They still have those unrealized losses.
All of them. Globally systematic important banks, they all have them.
They also have them. The only thing the banks have probably changed since that period of time is maybe increase the reserves a little bit, right?
Yeah, for risk of loss that they might see in things like commercial real estate or personal credit card loans.
Right, but not a whole lot of change, right?
Not a whole lot, no.
Yeah, so it's like those same problems still kind of exist, and you're like, what the hell's going on, man?
So let's go back to the article for a brief moment here. The climb back to pre-Silicon Valley Bank levels is happening because of a dovish, we know bitchish, shift at the Federal Reserve, which is hinting that it is done, not saying, hinting.
Yeah.
Hey, Saied.
Hey,
it's wink, baby.
It's the wink of the gun.
I might
take you on that date.
I might do that thing you talked about.
If you're lucky.
That one time.
Yeah.
Hey. I imagine this is probably the way Jada Pinkett talks to Will.
Oh, man. You gotta bring her up.
Hey, Will.
We were having such a good time.
Hey, Will.
I might do that thing.
I might fall out of love with Tupac and into love with you.
That's never gonna happen.
See, I might.
This is where that scenario goes out the window.
No, but it might.
It might. Just stay around long enough.
If your bitch is long enough. So, which is hinting that it is done raising interest rates after its most aggressive tightening campaign since the 1980s, which I would point out is before Saied was born. On Wednesday, Fed officials say they now expect the central bank to cut rates 3 times in 2024. And the market lost its mind.
Yeah.
Practicing that all day for today.
Yeah.
So that was a big shift in the sector. And it makes sense because a lot of people were investing that want to invest in these things and get upside potential. They were waiting on the sidelines. And I get it, but I would point out the Fed also has a really bad history of getting this right.
Oh, yeah.
Their predictions. Are you okay with that? You like choking?
Sorry, yeah.
No,
you're right. 11 out of the last 14 times we've fallen into a recession when they've had to raise interest rates to fight this off.